Sam's eyes open at 7:03 a.m. Before he even sits up, he checks one number: his bank balance. Lower than he pictured. More bills than he remembered. His phone buzzes, and money is already asking for a decision. Minimum payment on the credit card, or risk a late fee. Car payment, or keep cash just in case. He's only been working 2 years, but every morning feels like a test where the wrong answer follows you for years. What drains Sam isn't being broke today. It's the constant feeling that he's one click away from a mistake. Every swipe, every confirm. Same thought. Is this the choice I'll regret when rent jumps? When rates rise? When life happens? So Sam does what a lot of young Americans do. He avoids thinking. He lets autopay decide. Interest grows quietly. Fees show up without a fight. And the biggest money decisions of his life get made without him. Hello, this is Dax. Welcome to Dax Invest, where we share personal finance lessons through a personal lens, backed by research and real numbers. If you're 18 to 24, you're not bad with money. You're drowning in choices. Think about a random Tuesday. Rent is due. Your student loan app pings. A friend wants to split concert tickets. Car insurance renews. Your card balance is still there. Breathing. You can be smart, hardworking, and still feel trapped. Here's the uncomfortable truth. The more money decisions you're forced to make every week, the worse your results tend to be. Not because you lack willpower, because your brain runs out of clean, calm decisions. And then the system decides for you. Autopay, fees, minimums, buy now, pay later, and credit card interest around 20.97% at commercial banks. So today, we're going to shrink your money life into fewer decisions, fewer buttons, better outcomes, without needing superhuman discipline. You can spot too many money decisions long before a real crisis. It shows up as tiny, constant stress. You open your banking app like it's a weather forecast. You run a mental spreadsheet. If I spend $18 on lunch, can I still make rent? You hesitate before every subscription, every DoorDash, every weekend trip, because one wrong move feels expensive. And then there's the noise. 10 creators screaming, "Build credit, kill debt, invest now, save 6 months, start a side hustle, buy a house, don't buy a house." The problem isn't that any one tip is evil. It's that you're asked to decide every day which rule to follow. Zoom out and you'll see why this feels heavy. In the US, household debt is $18.59 trillion. Credit cards, $1.23 trillion. Student loans, $1.65 trillion. Auto loans, $1.66 trillion. That doesn't mean you're doomed. It means you're living inside a machine that runs on decisions. And the machine is bigger than your mood on a Tuesday. Let's talk about the shock part, calmly. A financial shock is when the rules of your money game change faster than your paycheck does. 1 month you're fine, then rent jumps. Your card APR resets. Your savings earns nothing while prices creep up. You didn't get dumber, the environment changed. 2 dials drive a lot of this. Inflation is the slow leak. Recently, US CPI has been about 2.7% year over year. Shelter costs were up around 3.2%. Interest rates are the pressure knob. When the Fed's target range is high, borrowing gets expensive across the system. As of January 21, 2026, the upper limit is 3.75%. You feel that 3.75 as higher card interest, tougher car payments, mortgages that turn a starter home into a math problem. And yes, the knobs move together. Don't memorize numbers. Notice them. Housing is where too many decisions becomes a trap. Because housing isn't just a bill. It's the platform your entire budget sits on. Picture a 23-year-old. Lease renewal comes in. Rent is up again. Parents say, just buy. TikTok says, house hack. Your spreadsheet says, maybe, if rates drop. Here's what the numbers feel like. National median existing home price, about $405,400 in December 2025. Average 30-year mortgage rate, around 6.06% in mid-January 2026. So every "should I buy" becomes 10 questions. Down payment, closing costs, insurance, repairs, property taxes, commute, refinancing fantasies. Renting has its own stress too. Moves, deposits, unpredictable increases. This is why fewer decisions matters. Not because buying is always right, not because renting is always right, because stability beats constant redeciding. Aim for a housing plan you can repeat for 12 months without panic. One more dial most people ignore until it hurts: the exchange rate. It's basically the price tag on your country's currency, how many pesos, lira, or baht it takes to buy $1. In the US, you might notice it when you travel, but globally, it can decide how expensive food, fuel, and medicine become overnight, because so much trade is priced in dollars. That's why the 1997 Asian financial crisis is a useful mirror. Several economies had exchange rates tied closely to the US dollar. When conditions shifted and confidence broke, currencies were forced to move fast. Everyday costs spiked. Here's the lesson. You don't need to predict the next crisis. You need a money setup that isn't fragile when the dials move. Rates, prices, currencies, jobs. Fewer decisions isn't laziness. It's building a life that stays steady when the background noise gets loud. When people say markets are nervous, they're watching two invisible things: CDS and liquidity. A CDS, credit default swap, is an insurance-style contract that offsets the risk a borrower won't pay. You don't have to trade it, just know the signal. When fear rises, that insurance gets more expensive. Liquidity is even more basic. Can institutions meet cash needs without taking ugly losses? The Fed describes liquidity as the capacity to meet cash and collateral obligations without unacceptable losses. Think of it like water pressure in the pipes. When pressure drops, lenders get picky. Credit limits shrink. Car loan rates change. The easy approval disappears. And suddenly, your budget has to absorb a higher minimum payment, right when you're already tired. So the goal isn't to predict headlines. It's to build a money setup that doesn't require constant approvals or perfect timing. Fewer decisions, fewer points of failure. When the economy gets rough, people argue about the Fed like it's a character in the story. Let's demystify it. The Federal Reserve's job, by law, is to aim for maximum employment, stable prices, and reasonable long-term rates. The main lever is the policy rate. Raise it, borrowing cools down. Cut it, borrowing gets easier, and the economy can breathe. The government has a different toolbox: taxes, spending, safety nets. Some support happens automatically, like unemployment insurance expanding when income drops. Here's why this matters. These levers change the background math of your life: your savings yield, your card APR, your car loan, your rent market, even how secure your job feels. So again, fewer decisions. If your plan only works when rates are low and jobs are booming, you don't have a plan. We're building something that survives seasons. Quick global detour, not to scare you, to recognize a pattern. When money systems crack, confidence falls. Capital leaves. The currency drops. Borrowing costs rise. Everyday life gets expensive. First, start with 1997 in parts of Asia, then Argentina. A fixed exchange rate can feel like stability, right up until it breaks. The 2001 to 2002 crisis involved debt default, bank withdrawal limits, and abandoning the fixed exchange rate. Different countries, same skeleton. Exchange rates, debt, confidence. And here's the only reason we're here. Your personal finances should be built like a good building code, not for sunny days, for the day the weather changes. So what does fewer money decisions look like when you're young, busy, and carrying school, work, and anxiety? It looks like turning choices into defaults. Default 1, 2 lanes, bills and life. Paycheck hits, a set amount auto moves to bills. Core bills auto pay from there. No guessing, no daily calculator. Default 2, 1 weekly check-in. Same day, same time, 20 minutes. Scan, balance, upcoming bills, 1 small correction. Default 3, 1 debt rule. If you carry a card balance, the minimum is not a plan. Pick a method, set autopay, make it boring. Because high rates punish, I'll decide later. Card rates at commercial banks were about 20.97% in late 2025. Default 4. One savings rule. Automatic transfers build personal liquidity, cash you can reach without panic. Notice what we didn't do. We didn't chase perfect timing. We didn't reinvent the plan weekly. Calm systems beat heroic motivation. That's the point. Think of Greece as a country-level version of Sam's Morning. For years, the system looked normal until it didn't. When investors stopped believing Greece could repay, borrowing got brutally expensive, fast. In May 2010, the IMF approved an unusually large loan while raising concerns about debt sustainability. Then, reality hit households. Fewer jobs, tighter bank credit, harsher taxes, constant new rules. In 2012, Greece exchanged a huge chunk of bonds, about 199.2 billion euros face value, for a package that created roughly 100 billion euros of net relief. Here's why this matters to you in the US. When the system is stressed, it doesn't ask permission. It changes the minimum payment on everyone. Higher costs, fewer approvals, more uncertainty. If your life requires 10 money decisions a day, stress turns those decisions into mistakes. Turkey shows the exchange rate version of the same story. When a currency slides, the price of imported things, fuel, phones, medicine, can jump, even if your paycheck doesn't. That's why inflation becomes a daily decision maker. Every grocery trip forces you to renegotiate your life. Official data shows Turkey's annual CPI inflation was 30.89% in December 2025. And in early 2026, markets expected Turkey's central bank to keep cutting rates from 38%, even while officials aim to bring inflation down over time. Notice what changed for regular people. It wasn't bad budgeting. It was the background math. When prices move that fast, the worst habit is constant improvising. Switching plans every week, chasing deals, delaying decisions until they get forced on you. Fewer decisions is a defense. Lock the basics, housing, food, transport, so the noise can't drag you into panic buying, panic borrowing, or panic quitting. Venezuela is the extreme case, and it teaches a gentle lesson. When money stops being stable, life becomes a non-stop decision storm. If prices change so fast that a paycheck loses meaning, budgeting turns into guessing. In 2018, the IMF projected Venezuela's inflation could reach 10 million% in 2019. When inflation gets that wild, people don't just spend less. They switch what they trust, often to another currency or to goods they can trade. Every choice becomes urgent. Buy now or it's pricier tomorrow. Hold cash or it melts. Accept any job because planning feels impossible. I'm not telling you this to scare you. I'm showing the pattern. Instability multiplies decisions, and multiplied decisions create worse results, even for smart people. So the personal finance move is simple. Build a setup where your next month doesn't depend on perfect timing or perfect predictions. Let's come home. Your stress is not imaginary. The New York Fed puts total household debt around $18.585 trillion in third quarter 2025. Credit cards, $1.23 trillion. Student loans, $1.65 trillion. Auto loans, $1.66 trillion. That's the system-level version of everyone making decisions under pressure. And pressure shows up as low personal liquidity. In the Fed's household survey, only 47% of adults ages 18 to 29 said they could cover a $400 emergency expense using cash or an equivalent in 2024. So if you're tire pops, you're not deciding between brands. You're deciding between rent and interest. If student loan payments restart, you're not choosing investing versus saving. You're choosing what bill to disappoint. This is why we reduce decisions. Not to be perfect, just to stop the system from choosing for you this week. Here's the point of all these numbers. You can't out-decision the economy. When inflation is 2.7%, prices drift. When the Fed funds upper limit is 3.75%, borrowing stays expensive. When credit card rates sit around 20.97%, "I'll figure it out later" becomes a tax on your future self. And housing? Median existing home price, $405,400 in December 2025. 30-year fixed mortgage, 6.06% in mid-January 2026. That combo turns one decision, where to live, into 100 tiny decisions. So we do the opposite. We build defaults. One bills account, one spending account, one savings buffer. Bills on autopay, savings on autopilot. And one rule for debt. If you can't pay it off this month, it's a no, unless it keeps you housed or employed. Fewer decisions, better results. Less fear. Let's translate liquidity into real life. The Fed defines liquidity as the ability to meet cash obligations without unacceptable losses. For you, liquidity is simpler. Can you handle a surprise bill without a spiral? If you can, your money life needs fewer decisions, because emergencies stop hijacking your week. If you can't, every small problem forces a big choice: borrow, delay, or cut something essential. When people can't cover a $400 emergency with cash, common moves are: put it on a credit card, borrow from family, sell something. So build one boring buffer, not huge, just enough to turn urgent into scheduled. Then use a decision filter. Keep housing paid. Keep transport working for work or school. Stop high-interest debt from growing. Auto-pay minimums, plus one extra payment when you can. Only then upgrade lifestyle. That's not hustle culture. That's peace. If you take nothing else from this video, take this. Stress isn't proof you're failing. It's proof you're being asked to make too many money decisions inside a system that changes the rules. Rates, prices, housing, credit, without warning. So don't aim for a perfect spreadsheet. Aim for fewer buttons. Decide once: your bill pay setup, your weekly money check-in, your one debt rule, your minimum savings transfer. Then let repetition do the work. That's how you win without drama. Not by predicting the next crisis, not by grinding harder, but by protecting your attention. Because attention is what the money machine is always trying to take from you. If this kind of calm, evidence-based explanation helps you breathe a little easier, subscribe to DAX Invest. New videos every week. Simple systems, real numbers, small decisions you only have to make once. And if you want a one-page checklist of these defaults, it's in the description.